So, why do mortgage bankers cut back on who's qualified to get a mortgage in the middle of a housing boom? Stay tuned for more. Good morning and welcome to this week's edition of NoteSchool TV. It is Wednesday and we go live every Wednesday at 11:05 Central. So don't forget to say hello in the comment box and also say hello and let us know where you're from as well. And if you're brand new, make sure and hit the like, the share, and then the bell notification so that you can get notified every week when NoteSchool TV goes live. And if you're brand new to Notes or to NoteSchool TV, make sure and go to NoteSchool TV to find out more about Notes and what we're all about at NoteSchool. So today we have our note industry update. So we have the latest, as I said in the teaser before we got at the very top of the show. Today is the day that we're going to pull back the curtain on what's going on and the research that we do at NoteSchool. Don't forget to ask your questions. And again, just to continue to check in as we go through the show. So it is my pleasure to let me go ahead and bring on our NoteSchool founder and head visionary, Mr. W80 Speed.
Hey, Joe. How are you?
I'm good, man. Good morning.
How you doing?
I'm doing just fine. So, Eddie, we have our note industry update today. And again, there's some interesting stuff continuing to go on in the world of real estate and the note business and finance and all of that, right?
I would say that it is my hope that you can draw some pretty clear pictures today to do this. And so this is the last Wednesday of the month of July, and every last Wednesday of the month, we pull together this market data. Now, Joe, today we have data from a number of sources, but Black Knight did an awesome report that we did a book report on, and they have an update.
Yes.
Right? Now,
yes.
The relevance of this update is not to say the same thing that we said before, but we're going to make some different points and different information. And we are going to focus specifically because they call this report the Mortgage Monitor, Joe.
That's right.
Meaning that they are telling us what is happening in the conventional mortgage business and why that relates to the overall market. And we'll have a lot of information. Joe, this is a pretty deep report. We are going to have a way that everybody can have access both to the report and some additional stuff that we pull together. So there's going to be a great way for people to index that. And Joe, I'm just going to bail off in the middle of it. Okay.
Yeah, we've got a lot of it. So why don't you let's share the news.
We'll do that. Okay, so I'm going to kind of scroll forward here on this report, and I'm going to go to the fourth page. So obviously, I'm not going to try to cover everything in there. And as you can see here, guys, I've highlighted this. And so as you can see right here in the report, then what we have is we have mortgage delinquency by severity. Okay. You know what, Scott, I'm going to fix this right now because it's not going to work out the way I want to. I'm going to stop sharing this screen and I'm going to share another screen. I'm sorry about this, but if you've ever been behind the scenes, you kind of know what I'm saying.
Well, it is live TV, guys. And
well, you know what I'd say? I'd rather fix it now than not fix it and figure out I didn't do what I wanted to. So
you got that right.
See. I'm looking for the PDF, and it's not showing me what I'm looking for.
And Eddie, actually, you had it up there, correct? I think he just
I do have it up, but it's a web version, and it's not letting me show what I want to show. That's why I'm trying to fix it.
All right. Yeah.
All right. Let's see here. Share.
So go to go to share. Go to share again. Then go to window.
Yep. Done all that. And guess what?
Now Scott has to make it live on screen.
Okay, Scott, can you see that?
Okay, we can't hear Scott.
Yeah, no, we can't see it. You have to open it up first and then go to the share screen.
Okay. So I'll do that. Sorry about that, but I had it all perfect, and then I realized that it wasn't what I wanted.
There it is.
Okay, there you go. Sorry about that. Okay, so page number 4, Joe, this is pretty dang important. Right here on this graph right here, this is mortgage delinquency. So, Joe, this is why this matters. These are loans that are delinquent, but they're not in forbearance.
That's correct.
Okay. 1.7 million seriously delinquent loans remain, Joe.
That's right.
Okay. Now, Joe, this is 4 times more than the amount of delinquency before the virus started.
Correct.
Okay. So, Joe, call it this. There's this many loans, 2 million, right?
Mm-hmm.
About a quarter of those were delinquent, call it just under 500,000 before the virus started. Now, Joe, by the way, those loans are being traded in the non-performing loans secondary market today.
Correct.
Right? Because they are the first ones that are going to hit the foreclosure status.
Right.
Right? And that's going to happen like in call it about 3 days.
Right.
Okay. Those are called legacy loans.
Correct.
Okay. So the remaining loans, these people opted not to go into forbearance. Okay. Why? Well, I don't know. They didn't go into forbearance because they couldn't qualify, or they weren't living in the house, or they were a landlord.
Right. Or they just didn't know.
Landlords could not get forbearance on GSE loans, government sponsored enterprise loans.
Right.
Fannie Mae, Freddie Mac, FHA, VA. This is a big number, Joe. Now, the good news is, I'm going to go the next one. That's going to be on the 6th page. The good news is, Joe, that number is going down.
Yes. Okay.
Which is great. 92.3% in June, 92.3% of every residential mortgage was paying. Is that good?
Yeah.
That means almost 8% weren't paying.
That's right. And 8% of 53 million is a big number.
So this is what we're trying to say, is we're acknowledging all the cool stuff that's happened in the market, but this is what we keep referring to as shadow inventory. And by the way, Black Knight wouldn't, if they didn't think it's a big deal, why would they go put such an effort into generating such an incredible report?
That's right.
They're doing this report because they think it matters, right? And by the way, I agree with them. I think it matters.
I think it does too.
Okay. All right. So let's talk about the other end of the spectrum, which is this portion right here. And Joe, that is going to be right here. This kind of says it all. If you look right here, it is fewer than 4% of mortgages are in forbearance, and that's the lowest since April of 2020. Is that good news?
Good news.
That's awesome news. Now, what's interesting is if you see my little finger pointing here, Joe.
Yes.
Fannie Mae loans are really not many of them are in forbearance, 2.3%.
Right.
just under 7% of FHA VA loans are in forbearance. So what are the most injured of the government-sponsored enterprise loans, GSEs?
Right.
Fannie Freddie. I mean, excuse me, not Fannie Freddie, FHA.
Right. Jenny,
Right.
which is, yep.
There, and so let's focus on that. If you'll go over to the next section here, if you can see my cursor, and that is that FHA has continued to make a large share of the active plans, now accounting for 40% of all the loans. You see, when you look at the pool of Fannie Mae, Freddie Mac loans in all the GSE loans, and you look at the pool of the FHA VA, it's not 50-50.
Right.
Right. The lion's share of GSE loans are Fannie Freddie loans, Fannie Mae, Freddie Mac. So they're way more than 50% of all of that group of loans. But 40% of the loans that are delinquent or in forbearance, they are FHA VA.
That's right.
Now, why does that matter? It would matter to me if I were a house buyer.
Absolutely.
It would matter to me if I were looking at where to target the market of people that had some pain that needed to solve a problem.
Correct.
You see what I'm saying?
Yep.
So this is why I do a lot of this for high-end real estate investors, because I'm trying to show them, like, there's the target.
Yeah.
You know, there's your customer. All right, Joe, let's move on. So here we have forbearance plans and removal. So, Joe, good news. There are of these forbearance plans, there are 460,000 plans that were reviewed for extension or removal in the first 2 weeks of June.
Right.
33% were removed. They were removed from forbearance.
Correct.
How could that be, Joe?
Just started making and just made a payment.
They
Right.
could start making payments.
Right.
So within forbearance says we're going to start making our payment again. Maybe
Right.
they didn't have a choice. Maybe all of their forbearance expired.
Right.
You see, the maximum term on a forbearance, Joe, is 18 months.
Correct.
Right? Now, here's the other problem. The other problem is that 67% went into another extension in forbearance.
That's right.
Now, so they weren't out of their 18-month period and they needed more forbearance. What is that an indication of, Joe?
Well, they can't make their payment, obviously.
Well, I mean, there's an issue there, right?
Right.
So it's like we're just trying to make sure that everybody's kind of seeing what we're seeing as far as, you know, these are stats. So 2/3 of the forbearances did not that came up did not roll out of forbearance.
Right.
They went back into an extension. Right. Maximum term on a forbearance is 18 months. All right. So let's look here on this section right here. And this shows us the final expiration of active forbearance. Joe, that says final expiration.
Well, you know, Eddie, it's been 16 months.
It's been 16 months. And remember, what's the longest forbearance period you could have?
18 months.
18 months. So if that's the case, Joe, look at this spike right here in September.
Yep.
See that spike in September?
Yep.
That means something. Let me go back to the right screen here. Okay, so that spike in September right there, as you can see my little arrow pointing, that shows you that there's no more forbearance available. Right. And then all of a sudden, Joe, from like it's September down to November, you just see it diving straight down. That's it.
Done.
It's over. So these forbearances are maturing, but look at the forbearance in July and August and look at the spike up.
Right.
Okay. So that's why we saw 2/3 in June, 2/3 of the forbearance. It says, hey, I'm going to extend my forbearance another 90 days.
Mm-hmm.
So Once again, what is this? Why does this matter? Well, we're talking about 2 million loans in active forbearance.
Yep.
Right? You know that when you talk to people that are selling traditional residential real estate, Joe, they're telling you that there's a shortage of real estate and it's going to go on forever. Just saying.
Just saying.
All right. So the annual price growth. Now let's talk about the crazy market conditions. So according to Black Knight, and they're the ones that produce this incredible Mortgage Monitor report. Thank you for that, Black Knight. You're awesome, guys. Home price growth hits its third consecutive all-time high in May.
All-time.
All-time.
Yeah.
With a growth rate of annual rate appreciation accelerating more than 2% in each of the past 2 months. What? 2% a month? So it went 13.4% to 17.6.
Yeah.
I don't know what you call a wow factor, but I call that a wow factor.
Yeah. Yeah. That's when you look at that and put that into perspective, that's, in the average price home being north of 350 and you add 2%, that's a huge number.
Yeah. Okay. Let's go to the next page. 13. Page 13 on the report. If you're going to listen to a recording of this later and track it along with the report, that'd be cool. First, top 2 states, Austin, Texas. Oh, my goodness. It is up 35%.
Yeah. That's a little scary, isn't it?
I don't know what you call scary, Joe, but that really, from an old boy that's been doing this about 40 years now, that's something. That's a number. And then, of course,
Eddie, that's like, we talk about in our 3-day class about buying with monopoly money. Are they buying with monopoly money in Austin? Right.
Well, the market's on fire. Right. Yeah. And here's what's interesting, Joe. Let's pick the bottom of the market.
Right.
Okay. New Orleans and Pittsburgh.
Right.
The 49th and 50th most appreciating cities are over 10%.
Wow.
The bottom of the top 50 is at 10% appreciation per year. Crazy, crazy, crazy. All right, Joe. Skyrocketing prices, though, are beginning to take its toll on affordability.
Correct.
Okay, this is huge. This is huge. So it requires, Joe, of $1,000 payment, it requires $191 additional payment to buy the identical house you could buy before.
Right.
That's up 18%.
Right.
Now, Joe, let me say it this way. That's with mortgage rates compared to mortgage rates today.
Right.
Okay. So is this skyrocketing price of residential houses going to take a toll on who can buy a house?
Absolutely.
Your mortgage payment changed 20%. So that's huge. Affordability. We've been talking about affordability and how it has an impact on the market for years and years. This is a huge thing. Okay. It's big.
So is there a correlation between the increase in prices and the interest rates continually going down so that fire can still be fueled? I don't know.
Well, here's what I'm concerned about, Joe. I'm concerned about us looking at residential real estate and not having a reality that now what we've done it has made it more exclusive than inclusive.
There you go.
I don't believe everybody needs to own a house because I don't think everybody's in a financial situation that, position for that. I'm not that guy. But I am a guy that says that the average person, you know, is not necessarily in a position for their mortgage payment to change 20% just because residential houses have gone up that much in a year.
Right. Exactly.
That's kind of that's a big factor. Okay, I got one more piece here, and I want to just show you kind of the condition of the market. So that's going to be on the page 20. I'm going to kind of scroll through. It's a great report, by the way. I'm not saying you shouldn't read all of it. I'm just saying that obviously we can't do it. So, Joe, do you see my little cursor here, my little hand?
Yes.
Okay, so I'm going to go to the bottom line. You see that little hand there?
Mm-hmm.
I'm going to go to the bottom line, and that is the end of May. Joe, there's currently active count of 53,062,014 mortgages. Okay.
First mortgages.
Yep. And I'm going to go over here, Joe, and the total that is not current, this is mortgages. This isn't dollars, Joe. These are the number of mortgages. 2,659,314, Joe, fall in the category of not current.
Right.
Okay. Now, you're clear with me. This doesn't mean that they're necessarily not all the ones that aren't paying, because these are loans that are not current. These are loans that are delinquent but not in forbearance.
There's the key. Right.
Okay.
So it's one plus the other.
You got 2 million, just under 2 million loans that are in forbearance.
Right.
You got 2.6 million that are delinquent. You add them together, I think you got some pretty fairly easy math, right? That's 4.5 million loans. Joe, here is the catch. I want to move over one more line. Okay. Excuse me, two more lines. This is average days delinquent for loans that are the severely delinquent loans, 90 plus delinquent. The average delinquency, Joe, is 339 days.
And Eddie, that correlates with, you know, people probably made their mortgage payment in March of 2020 and in April of 2020 and in May of 2020. And then you started hitting June, you know, July. And that correlates directly when a lot of people just, you know, they hung on and then they just couldn't make their payment any longer.
Well, my view of this is that we're entrepreneurs.
Mm-hmm.
We're trying to get an understanding and a read of the market, and we're trying to talk about why that matters. Okay? So why this matters to me is that if I am marketing to people that might sell a property to me at a discount, I become very laser focused on where to do that.
What that means and where they are.
Now, the other category, which, Joe, we are going to talk about next, is the hobbyist landlord. It's a small-time landlord. And by the way, his delinquency could be in these numbers. And by the way, he wasn't eligible for forbearance through the GSEs. Right? So that could be a reason that a landlord can't pay his mortgage, even because he's not collecting rent, and he wasn't eligible for the forbearance program. So this is pretty critical. Joe, I'm going to hand the slide deck to you, my friend. And because you're gonna kind of take us in another direction here.
Yeah. So, Eddie, as you know, we've gone through the Black Knight report, and we're just kind of reiterating a couple of things here. And this first slide that we have here, and I'm sure everybody can see that, correct?
Yep.
Okay. Very good. Mortgage rates continues a downward spiral. So last Wednesday's show, we talked about, you know, it was the third or fourth straight week of declining rates. Well, Eddie, it declined from 2.88 last week as of 7/22. Now it's down to 2.78 on a 30-year fixed. The 5/1 ARM has stayed about the same. Actually, it ticked up just a little bit, but my gosh, look at the 15-year. at 2.12.
Just almost just a tick over 2% interest. So we can't say you can't do business because rates aren't cheap. Rates are super cheap. That's not an issue. And I see this as an incredible market condition. In fact, with the affordability factor, Joe, I think it's probably a fair statement. With the affordability factor, if you can't, what if rates went up? Right. You've already said that mortgage payments have gone up 20%. Right. Because of the housing increase. So, somebody's house payment goes up. If rates go up, that compounds the issues. It's something to consider. All right, let's go to the next one, Joe.
All right. So here's Eddie, we haven't really talked about the mortgage credit availability index, but share with us now. And by the way, June is the latest stats that are available. Yeah. So share with us what that kind of looks like.
So Joe, do me a couple of favors. Take your highlighter and highlight June, just so they can kind of go up from there.
Yeah. Let me get from my pen to my highlighter. So let me go to that. And let's do this, and let's do this. And so here is June in here, and there's 118.8.
Right. That's the index that they have. This is the percentage. This is the amount of people that can get a mortgage.
Right.
Okay. So Joe, go back to June of 2020.
June of 2020 was 125.
No, excuse me, February of 2020, right there.
February of 2020,
just
right
highlight here. That, and then just kind of take your highlighter and kind of shoot it up, just where they can see. So obviously you can see when the virus started. And Joe, if you look back at about October of last year, this thing looked like it was recovering.
Right.
Right. And all of a sudden, now all of a sudden, this thing started dipping down, really, Joe, in the last month. The percentage change in a month, the percentage of people that could get a mortgage and now can't has dropped like almost 10%, Joe.
Yep, that's right.
In a month.
Yeah, in a month. Yeah.
What's wrong? What's wrong with these mortgage bankers? Don't they listen to the realtors? Everything. But you see, they are looking at variables like affordability.
Correct.
They're looking at variables like limiting their loan to value ratio. In fact, I thought it was interesting, Joe, that that really the big impact here, like jumbo loans were hit a little bit. They decreased by 11.5%. Right. Okay. But conforming loans, right? Fannie Mae, right? Fannie Mae, Freddie Mac, FHA, VA, that ratio fell by 23.5%. Boom.
And so, Eddie, what that means, the big picture is that people need a bigger down payment in order to qualify. And their credit score, we were talking about it having to be definitely north of 750. Now we're probably looking at north of, 770, maybe 780.
Well, and another thing that the report talks about is the tightening of the ratios of the debt to income ratio and also tightening of loan to value. So, look, mortgage banking is just looking at this market and going, if we're going to make a loan to you, we want to make sure that you've got some capacity that is outside of what we would have called normal in the past.
Right.
Right. That's kind of what it really is. Capacity to make a bigger down payment, capacity. And so those are areas for a concern. So mortgage credit availability, Joe, this says to me, if there's about 35, if you took 1,000 people that could get a mortgage before the virus, a conventional mortgage, this says about 650 of those people can get a mortgage today.
That's right.
Okay. And what that tells me is that the traditional mortgage banking industry has left a huge gap in the opportunity to offer seller financing. This is the biggest bonanza for helping people with home ownership with seller financing. And we didn't cause the mortgage banking situation. We're not gloating about it. We're just saying the market is the market, and where do you fill the gap to solve problems? Seller financing could solve a huge problem in the market because a lot of people now can't get a mortgage that could before.
Right. And, you know, Eddie, it's just kind of it doesn't add up when you say, okay, you can get a loan for 2.88 or 2.78 or 2.12 on a 15-year, but it's a whole hell of a lot harder to get that, right? It's not, that's the crazy thing, right?
All right, let's talk about who's buying property.
Yeah. So this thing has kind of changed directions as we've moved. So, you know, a lot of investors were buying duplexes, you know, more than one unit.
Yeah.
And
Joe, this is small time investors, right?
Small time investors. Not
this
big
is
hedge
the
fund
category
investors.
of the 1 to 10. He owns 1 to 10 units. So they've slid down. They're not buying quite as many multifamilies.
Right.
Right. But look at the red, Joe.
Yeah.
The red is single family houses, and it is up 16%.
Yep.
Small time investors.
Right.
I guess
it's only up
107.
It's up 107% year over year.
I think HGTV is doing good.
It was up 15% from Q1 to Q2, right? And it's up 74%. And, you know, 74% of those investors bought with cash.
All right. There's a little issue out there, Joe. We need to talk about it.
Yeah.
It was in the Wall Street Journal, just came out.
Yep.
And the issue is the government passed this legislation to give assistance to tenants for rent assistance.
Correct.
Okay. And the problem, Joe, is that the small time landlord has struggled like crazy to connect to this money.
Right.
8 million people owe small time landlords money. Okay. They own 1 to 10 properties. There's 8 million people that owe, and I call them hobbyist landlords. Right. They owe hobbyist landlords money. So the government comes in and says, "Oh, don't you worry, baby. We got this.
You got it taken care of. Yeah.
We're going to take care of this. It's going to be this program, and we're going to give this money out to the states, and they're going to delegate it and have their little special areas, and they're going to get it done." Now, Joe, there's an issue. They haven't given the money out.
That's right.
Like, it's just a tick over $2 million or $2 billion that they've given out.
And there was 48 billion, I believe, is what was available.
So anyway, I've got a copy of the article here, and just some of the highlights in the article. It's 47 billion in federal money was aimed at helping tenants who can't pay rent because of COVID. 47 billion. Okay. And that's all fine and good. But then if we categorize it down, now remember, the small time landlord dominates in the single family rental business. He's over 70% of the market. So it's not the hedge funds that own all the houses, it's small time landlords. And when you go look at all this, Joe, when you get down to it, Joe, this tells me that a small time landlord would be very, very, very motivated to sell his house to me and offer me seller financing.
Right.
In fact, Joe, I have a strategy where I could even show him how the capital gains, just because the market's taken care of him and the house has gone up in value, right, even though he hasn't collected rent, he could stretch his capital gains out and pay that over like 15 years. He wouldn't have to pay it all up front.
That's right.
A seller financing strategy could be really smart. Joe, you and I have been working on a campaign that is exactly related to that.
Yes, it is.
Right? So this is a great scenario, just showing you what we call pain in the market. There's great stuff in the market, and we're glad for people that are experiencing great stuff. But if you're an entrepreneur, you're always looking for a void in the market and how to fix it.
That's right.
There is a lot, Joe. Let's just call it voids in the market and awareness.
That is correct.
Joe, what do you think, pal?
Well, I think we did a very good job of covering what's out there and the different aspects of it, right? We covered that real estate is just on fire, but then there's that underbelly that, that most people don't know about. And it's in those creases, right? You said that it's in those creases and it's looking for those. And this is, there's a pile of this, and, and after this moratorium, is over on the rent thing, there's going to be such a backlog that it's going to take even longer. So,
okay, we want to make sure that people can get these documents.
Yes.
Okay, so we've got a band here. Maybe we've posted it in the past. Sometimes when I'm doing the show, I can't see quite all that's on the screen, but
there it is at the bottom of the sheet screen there.
All right, so email us, info@noteschool.com. The subject line in your email, just put market update, July 28, 2021. And we will be thrilled to send you both the Black Knight report, and it's the one that we colored up. And then also we're going to send you the PowerPoint slides that has these charts and stuff that we discussed. So if that's of value to you, we'd love to do that. Just email us, info@noteschool.com. Make sure to put in the subject line, because we do a lot of different reports. And so my guys need to, my team needs to know which report to send you, right?
Right on.
All right, Joe, let's bring this thing up.
We're going to go into the after party here in just a minute. But before we do, we want to talk just a little bit about our sponsor, Notes Direct and Feeding Frenzy Friday. All right. I love that. And by the way, no animals were hurt in the filming of this, right? Just want to make sure everybody knows that. So guys, stay tuned every Friday for Feeding Frenzy Friday, where every Friday we showcase an asset. And actually, I will be on with Brian this week. Scott Tyler, who you normally see on Feeding Frenzy Friday with Brian, is taking a little vacation this week. So Brian and I showcase an asset, a non-performing asset in Mississippi. So anyway, so make sure and check for that. And you just go to NoteSchool TV and go to the YouTube channel for Feeding Frenzy Friday and check that out. So guys, again, thank you for being with us this week. If you make sure and info@noteschool.com if you want the slides plus the Black Knight report, and we will promptly get those out to you. Make sure and join us every Wednesday as we go live at 11:05 Central Time. Next month, in August, which will be next week, our theme will be non-performing loans. So our first guest for the month will be Chaz Quinn, who is with Revolve Capital. And Revolve is going to, and Chaz is going to come in, and we're going to talk about what's going on in the non-performing loan industry as we move forward as well. So thanks so much for being here. If you want to, right there on the screen, past episodes, and if you want to know more about NoteSchool, right, make sure and go to NoteSchool TV, or just check us out. And noteschooltv.com/TV, and we will be happy to get back with you with anything you have. So that's it for this week. Make sure and stay tuned for next week's episode. Guys, stick around. We're going to spend just a few minutes in the after party, so join us there, and we'll answer any other questions you may have. So thanks so much. We'll see you next week at 11:05 Central Time. Well, there you go.
I will tell you that these these data slides to me help all of us make good decisions about market opportunities. I believe that the small-time landlord is the most stressed guy that owns a property, Joe, that statistically has a lot of equity.
Right.
Small-time landlord has 50% of them have a mortgage, 50% of them don't have a mortgage. They may not be collecting rent, but they don't owe a bit. They're not in high default of their mortgage, a lot of them, because they don't have a mortgage. And I think why that matters is I think they're the perfect candidate to seller finance. And I think this capital gain strategy of stretching that out with installment sales over the next 10 years. And this is a gigantic program that we're pushing our coaching students in the direction of doing. Right. I mean, we're not like, we are full speed ahead, because once again, the data is telling us this.
Right.
We're not blindly throwing a dart at the wall. We are throwing a dart at a target that is a very identifiable target. And the data is the one that tells us where that target is and how to pursue that.
That is 100% correct. So, Eddie, Kevin Goldman asks, can you say something about the meaning of the credit availability index level? What does the 118 signify?
Well, Kevin, the Mortgage Bankers Association has come up with an index, and there's a definition to it. At the height of the index before the virus, it was like at about a 190.
Yeah, 185, 190.
And so there's a like, call it, 20 variables that go into that, Kevin. So, I mean, if you're dying to know, you could go to Mortgage Bankers and they'll have a printout of what drives factors in the index. But it's just an index that essentially defines who can get a mortgage today versus who could get a mortgage yesterday and tomorrow and all that kind of stuff. So it's a great question, but yeah, it's just an index that they built. There's not a sentence or two explanation of what all's in it.
So, Kevin, at 185, that almost goes to the fog a mirror and have a pulse, right? And then as it drops to 118, it means you better have a big down payment, you better have perfect credit, and your debt to income ratio needs to be right on the marks, right? At 26 and 35. That's
it. Low, yeah, that's a good point, Scott. Lower the number, fewer people can do it. It's a great point there. Okay, yeah. So Glamour Properties said that the article in the Wall Street Journal article said it was 47 billion.
Right.
And I know that they're saying 55 billion. So there may be some other special classification or something in there that as to why that was different. But yeah, that is absolutely the case. This Black Knight report. And we'll make sure that we can, I believe we can download it and stuff, something in the show notes as well. But we'll make sure you guys just email us. We'll be glad to send it to you. It's good stuff. And I'll tell you this, when I do a very advanced group, like when I've got the, top 200 real estate investors in the country, if I'm an audience like that, and I'm doing this is the kind of stuff I show them, because I'm trying to show them where I think there's a void in the market that they could feel, they could have a niche instead of just trying to attack all of real estate, which we generally know is on fire right now, right?
That's right. And, it continues to, the variables are all over the place, as we've talked about. And the more data and the more you understand that data, the better off you're going to be. And that's what we do for you at Note School, right? We put it all together and say, Eddie's we've been calling this for a long time, and we're seeing it.
Yeah. Yeah. And we're going to give you this report. Black Knight, this is not our report. This is Black Knight's report, right? But it is just, we're going to give it to you. We're not charging anything. They didn't charge us anything. What we think the value is we sort of dissect what they say. It's such a monumental report. If you don't kind of know what you're looking for a little bit, it's kind of easy to read over. We're not trying to make the report sound good or bad. We're just trying to dissect what we see in the report.
Right.
Joe, you know what I like to say about this time?
Eddie, I think if I were guessing, it would be, I am out of soap.
As the old mayor of Lukenbach, Texas once said, Joe, I'm out of soap.
Very good. So, guys, thanks so much. Make sure and stay tuned next week. Chaz is going to he's going to bring a wealth of information to the show. Thanks again for watching today, for hanging with us in the after party. And yep, you're right, Kevin. Understanding it is the key. And that's where we try to take the mystery out of that. So, guys, thanks again. We'll see you next Wednesday, 11:05 Central. Bye-bye now.